Well, good afternoon, everybody. Very excited for another episode of the Industrial Real Estate Show. And I'm thrilled to be joined by Phil, him and I had the opportunity to chat last week just about industrial real estate and some of his experiences from multifamily to industrial. So I'm really excited to get his experiences and his insights into the industry and talk all things industrial real estate. So with that, Phil, thanks so much for joining me on the show.
Thanks for having me, Chad. Looking forward to the conversation.
Yeah, so you and I chatted a week ago or so and got a pretty good discussion going. But just for anyone who doesn't know you, if you could just provide a little bit about your background.
Sure. So I work for a commercial real estate investment firm focused primarily on value-add industrial Class B, not so much in the Class A space. We have a smaller multifamily platform as well, but we currently own about 11 million feet across the Southeast, Southwest, and Midwest. And I focus exclusively on capital raising. So we raise on a syndicated basis, project by project, deal by deal, sometimes portfolio transactions, sometimes individual buildings, typically 250,000 feet or below. Typically, we're not buying bigger industrial buildings, Class A, bulk distribution facilities. We'll occasionally look at those deals if there's a value add component, but we're not looking at million square foot buildings that have a single tenant on a 15-year lease, 3% step ups that are basically bond-like equivalents. We're very much multi-tenant, infill locations, good highway access, and I work for an owner operator that has the asset management, property management capabilities. We handle leasing, acquisitions, due diligence, and then I work on the capital raising side. We've been in business for 40 years, so we have long-term investors who've invested with us for that entire period, and I help supplement those raises with my investors, which includes high net worth individuals, RAs, and family offices are the main groups, but anyone who wants to invest passively without control or decision rights.
Very cool. When you're talking to investors, and there's a few things I want to explore about how you guys look at deals and what's attractive to you and how you look at any deal in particular. But even before that, when you're having conversations with particular investors or interested investors, what's your message to them on why industrial?
Industrial is more diversified than a lot of people think. So I'm just talking about the high net worth, but this is really applicable to a lot of RAs as well. When they think their real estate sleeve, and you got to remember these guys are thinking about a total portfolio allocation, so across asset classes, public and private markets. But when they think about private real estate, they often default to multifamily because it's more relatable or understandable. There's a lot more of the get rich quick type characters out there who are saying that you can quit your 9 to 5 if you invest in and operate multifamily. Industrial is a little less known, or it's more known now, but 20, 30 years ago, it was not a desirable asset class. But when you really dig into the characteristics and then the types of tenants you can attract, the diversified rent rolls you can implement, you can stagger leases, and it's not as operationally intensive as multifamily, it suddenly becomes very attractive. I spent a lot of my time educating investors about industrial, but once you explain things like a triple net lease structure versus multifamily where you can't contractually pass through increases in property taxes, insurance, CAM, that's a big driver, and a light bulb goes off in investors' heads because they are acutely aware on a personal level and with their investments that property taxes and insurance have skyrocketed over the past few years, while rent growth has slowed down considerably, especially with multifamily. And because most of these investors have dedicated most of their real estate allocation towards multifamily, now they're seeing some potential distress coming down the line, especially with older vintage multifamily. Eyes are opening and they're more open to the possibility of investing passively in industrial. That being said, it's been a markedly different environment over the past few years because of the run-up in interest rates. And so even though industrial has garnered more interest, that's been offset a little bit by the fact that rates are much higher. And a lot of investors right now are just more interested in credit, whether it's risk-free treasuries or real estate credit, private credit, public credit, distressed funds, because levered returns in the mid-teens for common equity isn't as attractive when Fed funds in the U.S. is 5.25 to 5.5. It was a very different relative risk return proposition when Fed funds was 0 to 0.25%, but with a run up of 500 basis points on the benchmark rate, it's a different calculation for investors. We raised for 2 deals last year. We had a lot of investors who liked the characteristics of a portfolio in Atlanta, had a great lease-up potential. We're buying it with positive leverage. That's not something we see often in deals, whether it's industrial or multifamily. It's a little bit easier with industrial. The spread isn't usually quite as wide as it is for multifamily, and you can reasonably underwrite to a pretty good stabilized yield on cost. But it was one of those things where investors just said, I'm going to just wait out some of the uncertainty, and it's not a bad place to be earning 5.5% while I do that. And I understand that perspective because if you're worried about downside risk and uncertainty and have no idea where interest rates are going or have no real thought about it, then you might as well wait it out. And so last year was just a difficult environment and to raise money, but also just to acquire deals because deals on paper just didn't make sense unless you underwrote them very aggressively, which we're not in the business of doing.
Yeah, it's interesting because I've anecdotally had the exact same experience as an investor myself, where I've had the opportunity to add to my own portfolio, and I've also had the opportunity to go in as an LP in a couple of different investments, and I've passed on everything for that exact same reason, is that you can get safe money right now for 5% with very quick liquidity. Whereas if you're going in on an LP project or you're buying a new property, you're looking at a 5 to 10 year hold versus buying a 3-month treasury where you can liquidate that very quickly with no risk. So I myself even fall into that camp of being very reluctant to get into a deal until there's some more clarity on what's happening with interest rates. With how investors are looking at industrial, and I know what questions I would ask, and I have asked, whether it's an investment myself or I'm going in as an LP. What are you hearing from investors that don't have any knowledge of industrial, and you're going through and you're saying, well, here's all the advantages for it, full pass-through leases being one example, long-term tenants being an example, credit tenants. What are some of the questions that come up from a layman who just isn't even thinking, who has no experience in industrial, but they're intrigued by it? What are some of the objections or questions that you answer regularly?
So the first thing I usually get is I mentioned the conversation contrasting multifamily versus industrial. The second layer is I'm usually contrasting Class A bulk distribution versus Class B flex industrial. And so when most people come in new to industrial, they think Amazon or FedEx warehouse. But then you peel back the onion and you say, well, it's actually a little bit more than that. And you don't necessarily have to have such concentrated tenant risk at these assets. And you can have a number of different tenants with leases coming due at different times. And you explain it. I mean, all these investors are accredited. We raise money through a 506B exemption. They all have to be accredited by net worth or income requirements. And so most of them are pretty naturally smart people. So if you take some time with them, and usually they're eager learners by nature, you explain to them that these are businesses that sometimes it's their sole location, it's their sole regional location. Sometimes it's not necessarily an investment grade tenant, but usually you get paid for the risk. You walk through some of those fundamentals and the fact that these aren't necessarily longer leases that you would see for a Class A facility, but because of that, you can mark to market the rents a little bit faster and generate your value add that way. And you can usually cure some deferred maintenance, buy it below replacement costs, and execute some lease up. Then people start to understand it. I think there's a notion that it's unattainable, the knowledge for industrial, because there's just not a lot of information about it. And we were talking before we went on the air about how there aren't that many industrial podcasts. But if you search multifamily podcasts, there are going to be a slew of them out there. And I think what's happened is they've heard that real estate in general is an inflation hedge, and that's top of mind given the inflationary environment we've been in the past couple of years. But then when you explain why it's more of an inflation hedge with industrial lately than it's been for multifamily or even Class A industrial where you have your fixed step ups, then people really start to get interested. And in some of the flex portfolios we own, market is often 3% for annual escalations, but oftentimes we're getting 4, sometimes 5% on the step up. So that's an even better embedded inflation hedge, and that's on NOI growth. That's not going to be net, on multifamily, hoping that your rent growth outpaces your expense growth, which is just not going to be the case, especially for Class B multifamily. And then adding on to that, when you talk about multifamily versus industrial, just very high level, I get the question about new supply for industrial because that's a common question for multifamily. But new construction for multifamily typically tends to be Class A, fully amenitized wrap product, and that can have a domino effect on Class B and Class C industrial. But when new industrial supply comes online, it's typically catering to a 500,000 square foot user or above. It typically has 40-foot clear heights, big truck courts, sometimes cross-dock facilities, and it caters to a very different tenant profile and a user mix. And so it's when I get those questions from investors, I say, well, our average tenant profile, 80% of them are under 10,000 feet. And so if there's a million square foot bomber building coming up across the street, our existing tenants are not a candidate to go across the street. It's not competing product.
Yeah, and I would say of all of the major markets that I've looked into in North America, that is a storyline that goes across the board. All the new inventory has been focused on distribution, logistics space, that big box warehousing space, which isn't easily demisable. Even if you have that million square foot building, you can't demise that into 10,000 square foot bays. At best, you might be able to demise it into 250,000 square foot bays. But you're right, that 10,000 square foot tenant, it's not at all in their wheelhouse. What concerns, because this is one thing that I hear all the time, even from people that have dipped their toes into industrial, is they always wonder, well, what happens if the tenant leaves? Who comes in and leases that space? And there's just, I appreciate this. I appreciate the fact that unless you're in the industrial space, that's a legitimate question because you just don't know all the different types of companies that are out there, whether it's home services companies or local distributors or local manufacturing companies. Unless you're in that space and you can fully understand how wide that market is, that's a question that always comes up and that speaks to the downside risk as well. If you have a property and let's just say it's a 20,000 square foot Class B building in suburbs of Dallas, and maybe you have 2 tenants in there and both tenants leave, is it as easy in your experience to fill that building as it would be to fill a 2-bedroom apartment?
Yes, for the reasons I described earlier, because the new product coming online, you mentioned mostly bulk distribution facilities, are not competing with the types of spaces that we're leasing. Vacancy is tighter for Class B flex than it is in any multifamily market in the country. And a lot of these tenants are really focused on the functionality of these buildings and the locations. And new product just doesn't come online for these spaces. And the beauty of Flex is that you can cater to a wide range of tenants. So you can have a home health services company, you can have a medical device components company, you can have general contractors. And sometimes space isn't necessarily designed for every user, but for the most part, we have the flexibility to adapt to the market. And so I'll just give you a couple of examples. We own a number of flex deals in Atlanta. We built out about 2 million feet there. We bought deals with relatively higher office finish, but we were able to convert some of those spaces, add some dock doors, grade level doors, and lease, and because we knew that's where the demand was in the market, and we were able to get significantly better leasing traction. Now there's some trade-off because you're going to get lower per square foot rents than you would have if it was more of a high office finish, but your TIs are going to be lower, they're going to be more predictable, and you typically get a pickup on your exit cap for a lower office finish.
Yeah, that's a great point. And even on just how wide it is, I actually walked through a space a couple months ago, and the company that was in there, they serviced and repaired arcade games. So the whole warehouse was just filled with pinball machines and Pac-Man and everything you can imagine. And there must have been 100 of these in different stages of repair or tear down and rebuilding. And I remember thinking, I've been through a lot of spaces, and I never would have even occurred to me to think that there is a company that repairs these arcade games, but everything needs to be repaired because everything's going to break down. So there's such a wide array of tenants that are out there. And then another thing that I've found as well is that with industrial leases, you typically have a pretty long lead time to release those. There's probably a provision in most leases that if they're going to renew, they've got a 6-month option to renew. So if they don't exercise that option to renew, or if you're not having that conversation with them, you've got a 6-month window to start marketing that space and try and get a tenant in there. And in my entire portfolio, I don't know if I've had a space sit vacant for more than a couple of months because of that. Because if you're a prudent operator and you can get ahead of that also mitigates that downtime risk.
Yeah, and that's right. I mean, we have relationships with local leasing brokers in all the markets we operate in, and so we'll have plenty of heads up, sometimes even 9 months to a year when we know a tenant's about to vacate, so we can start to aggressively market the space. A new tenant might not necessarily be able to occupy right away because you got to do maybe the specialized TI build out. But you're not going to, those spaces aren't necessarily going to sit vacant, or they're not going to become static vacancies or mothballed spaces. But for the most part, you're going to be able to have time to identify the tenant. You're going to have some windows for prospective tenants to be able to tour the space, even though current tenants are in the space. And, we underwrite, in most of our deals, we underwrite conservative downtime, probably more than we need to based on our asset management experience. But it's like you said, I mean, if tenants blow out or they're delinquent or they default on their lease, usually we're able to move them and get pretty good leasing interest from leasing brokers pretty quickly.
Mm-hmm. Yeah, that makes a lot of sense. What's your average tenant profile? You said 80% are under 10,000 square feet. Like, what is the average tenant in terms of what they do for business?
A lot of contractors, home services contractors, or contractors that work on buildings, piping companies. There's some distribution as well. I mean, most of our suites have dock doors, and so some will use 12 to 18 foot clear heights. So it's not a volume distribution facility or facilities that we own, but there's definitely a distribution component. But the nice thing about these spaces is these tenants, what you talked about walking through these spaces, a single space could have a manufacturing component, a storage component, a distribution component, all in the same space. And so it's home services company, for example, they might have materials in one part of the facility and then have heavy or light machinery in another part, and then a distribution section as well, or light assembly portion of the same space. So it's a mix. We have a number of healthcare related companies as well, not necessarily medical office, although we do have some of those types of tenants, but tenants that assemble and manufacture medical components or medical equipment for hospitals, for private physicians, you name it.
Yeah, it's endless on how many different types of uses that are out there. What I say to someone, if they just really want to get a scope of how broad the industry is, just go on Google Maps and locate where the industrial area is in your city, and using Street View, just start going up and down the roads, and you'll see businesses and buildings that you had no idea existed before. And it's an endless amount. So when you're looking at buildings, then how do you decide what's something you want to pursue? Do you start at the city level, like identify which markets you want to be in? And maybe let's start there. Like, are there markets that you will consider and then markets that you just won't consider?
I would say for the most part, we're relatively open as a firm to new markets, although we have some preferred markets. So we have a big presence in Atlanta, in the Midwest. We have a big presence in Chicago. We have asset management and property management teams in both those locations. Our second and third largest offices outside of our home headquarters in Dallas. But we like markets such as Minneapolis, Columbus, Cincinnati. We have extensive holdings there. We typically don't invest in the coastal gateway markets because those to us are not really value add markets. Those are you're going to be chasing those deals against big institutional players that are backed by core plus money, and so returns expectations are going to be lower. We're typically targeting mid-teens returns, and we're looking for a little bit more growth than you can get in New York or California or the New Jersey or Baltimore. Some of the markets we've looked at periodically, but we've never gotten any real traction. We look at Florida broadly, but Miami is one we look at, but pricing is just very expensive and it drives the cap rate down. And with rates where they are, you're staring down 150 to 200 basis points of negative leverage right out of the gate with LTVs ranging from 50 to 55 just because of a higher rate environment. And so if you model it out and you try to figure out what your value add is, you often don't stabilize above your cost of debt. And so if you look at it that way, it doesn't make a whole lot of sense. We're based in Dallas, but we have not done a lot in Texas on the industrial side, which is amazing. I think it's just a function of a lot of money has been chasing Texas markets, Dallas and Austin, but also Houston. The demographics and the job growth has been astounding, and that's driven demand for industrial assets, multifamily as well. But industrial has garnered a lot of interest from groups, from big investor groups, international investors who used to just invest in coastal gateway markets as a way to hedge their home currencies and just have U.S. dollar exposure. But now they're coming into secondary high growth markets like Dallas and Atlanta, and it's made it competitive. And we're not in the business of just deploying capital just to deploy it. We don't have a fund. We don't have an inherent pressure to get capital deployed within a deployment window, and so we're able to wait and be patient and find the deal that we're looking for. That being said, it's been a difficult deal environment because a lot of sellers in industrial haven't really had the need to sell because operationally and with leasing, it's been pretty robust in all the markets we've been in. There isn't the type of distress or over leverage that we're seeing in multifamily. And coming down the pike, we feel like there's going to be much more distress in multifamily than there will be in industrial, which has made it harder to buy industrial. But there is some, but the upside in industrials are fewer market participants who are competing for our size deals. So typically we're looking at deals between $10 to $50 million purchase prices. If you go above that, you're starting to compete with the big funds and they'll drive pricing up and the deals stop making sense. Under 10 million usually doesn't make sense. It's just usually not worth the time. We'll look at deals under 10 million strategically if we're trying to break into a new market or we feel like it's a good bolt-on to an existing portfolio that we have in a local market as part of an aggregation strategy as part of a disposition. But we'll look at new markets all the time, just mostly exclusive of coastal gateway markets.
Is there a population size that you want to have as a minimum threshold?
Not particularly. That's not one of our general criteria. I mean, we don't want to be in a very tertiary market where you're in small towns, but industrial is a little bit different, right? So if there's some suburbs of Dallas where population size are 20,000 or below, but they have great highway access. You're 20 minutes from the Metroplex. And so if we see a deal in one of those markets, that's not going to preclude us from looking at it because it really has all the demand fundamentals that we'd be looking for, even though the surrounding population might be smaller than we would like. For us, that's more of a multifamily consideration.
Interesting. Talking on that a little bit more, what are some of the demand drivers that you're looking at for markets?
For industrial?
Yeah.
We spend a lot of time with leasing brokers, understanding where new leases are coming in, what's going on in our portfolio, what's going on in other markets. We spend a lot of time talking with investment sales brokers as well as leasing brokers, and we're mining data to try to understand where we can reasonably underwrite some rent growth and manage our downside risk. And so we're hyper focused on downside risk now because of where we are in the market and where pricing got to. While pricing has come back a little bit because of the rise in interest rates, it's still very high. And multifamily and industrial has been the two best performing property types since the pandemic. And so pricing is still elevated. And our view is if you buy it at a bad basis, even if you perform operationally, you still expose yourself to downside risk. So we're really trying to make sure we're not overpaying. So I mentioned lease comps. We're also looking heavily at sales comps to make sure from a number of sources. So we'll look at the public stuff, the CoStars of the world, but we're really trying to get granular to make sure that we're getting good relative value and not overpaying or not being unreasonable in our underwriting assumptions. We're still actively looking at deals. We often get outbid by groups that we don't really understand how they're underwriting it, or maybe they're light on their CapEx or they're dropping their exit cap rate 50 basis points versus what we underwrite. But we don't want to be in the business where to make a deal work, we're too light on all the capital requirements or the TIs or the leasing commissions. And then we need to rely on 100 basis points of cap rate compression to make a deal pencil to a mid-15s return. And investors, when you go out and raise money for that, investors are going to see right through that, as they should.
Hopefully, because you're back to that earlier comment you made about you guys not needing to deploy capital. There are a lot of syndications out there that's their business. Their business is on collecting fees for deals that they get, and they probably have an acquisition fee, and they probably got disposition fees, and they are in the business of deploying capital because their fees might be their livelihood. So there is a difference between a group like you who's that prudent, smart money. And I'm not saying every syndicator is out there rushing to do it, but that there is that temptation as a syndicator to rush out and do a deal just for the sake of doing it. And if all you need to do is lower your exit cap rate 50, 100 basis points to make your pro forma look good, that's not a big leap, especially if you're an unsophisticated investor that's just taking them at their face value.
Yeah, the problem with that is it's very short-term thinking, because if you don't hit that exit cap rate, you're going to well underperform your pro forma, and then you're going to have to have difficult conversations with investors later. If investors feel like you're upfront with them, even with some bad news along the way, they can accept that. But if they look back at their investment memorandum and you're way off, and they see that you underwrote 100 basis points of cap rate compression where you actually had to pay 100 basis points higher, then they're going to say, well, what really went into that? They're going to start to question it a little bit more. And I think what's going to happen, and you mentioned there are some unsophisticated investors, and I think that's going to be a story that plays out on the multifamily side going forward. And unfortunately, a lot of investors are going to get burned with groups that promised the world and over-levered and maxed out their senior loan proceeds and then stacked on mezz debt or preferred equity to juice returns. And I mentioned property taxes, insurance are an issue. You can't pass them through in multifamily. Those investors are going to scrutinize sponsors more going forward than they did before, or the feeder funds that a lot of doctor groups create feeder funds with their members. And there's going to be a lot more scrutiny of sponsors going forward, just because the rise in interest rates accelerated the process, because a lot of the multifamily borrowers are using floating rate debt, and their forward curves didn't anticipate Fed funds going to 5.25 and SOFR rising commensurately. And so I think what's going to happen is they're going to look at a lot of the investors who stay in the market. You're right. There are going to be some unsophisticated investors who just say, I'm out. I'm not doing private syndications anymore. I want my exposure to real estate through publicly traded REITs or Blackstone core open-ended fund. But the ones who stay in are really going to look closely. And a lot of them, I think, are going to have some PTSD with multifamily. And part of that is going to drive them towards industrial. And and maybe some other property types. Probably not office. Office is its own unique animal. But industrial, I think, is going to gain a lot of favor over time. It's going to be perceived as more stable, even versus office. You don't have the lumpy cash flows like you would have for office, where you have huge TIs. The tenant blows out, you have more concentration in an office tower. The industrial tenants we have, they're not necessarily work from home tenants, so you don't have that risk, or they're not going to downsize. They need most of our tenants need these spaces as their central location, sometimes their only location. And if they have to give up their space, they're out of business. It's their livelihoods. And so they're highly motivated.
I want to jump into downside risk a little bit more, because this is also something that I'm very cognizant of, and everything that I do, I'm very similar to your style. Downside risk first. If we look at industrial broadly, there's warehousing. We've talked about that. That's the big box stuff. I think the biggest downside risk in that sector of the market right now is that it's outside of the coastal markets. You can build almost anywhere. Like in Dallas, I think you guys added 70 million square feet worth of inventory last year, and you could probably double that if you had to by adding new industrial parks. So I think that's always the risk on the warehousing side. If you're in a market with flat land and you can build and grow in any direction, you can just keep adding new inventory. And at some point, the cost keeps escalating, and there's advantages for the older stock as a result. But on that Class B, that older industrial stock, as we've talked about a few times now, it's fixed. That inventory has not been added to a whole lot. It's very expensive to build that out from scratch compared to what a lot of the cost basis is and the existing rates. So I think that insulates that Class B market from new inventory being added. But with that, where do you see downside risk in that Class B market outside of the big box industrial?
Sometimes when we buy deals, we see rent rolls with a lot of tenant concentration within a specific industry, within a specific or time, leases coming due at the same time. And the way we try to mitigate downside risk is we try not to have too much concentration for any one business. So if we have some tenants who are more exposed to the business cycle versus others, we don't necessarily want, if the business cycle slows down or the economy goes south, we don't necessarily want our entire rent roll to be exposed to that. We might have some tenants that are more defensive in nature, and they're not exposed to they're not interest rate sensitive businesses. They're not business cycle sensitive businesses. And so we try to protect downside that way. Knowing the markets and knowing where leasing is coming in is a big one. We talked earlier about once we know a tenant's going to vacate, we have enough time to really survey the market and find a tenant before the existing tenant moves out. And then staggering the leases, that's a big one. We typically don't want more than 15% of the rent roll expiring in the same year, because even if a couple of tenants leave in any one year, we still have enough time, and we have enough cash flow to be able to comfortably service our debt, fund our capital needs while we work to re-tenant the space. And with a bulk distribution facility, if you have a tenant leave, suddenly you don't have those coupon-like payments, and then you have to suspend distributions because now you've got to find a tenant, and then you have to reinvest in the TI and leasing commissions once you find a tenant. And so you have much more concentrated risk in that segment, not to mention the fact that you mentioned 70 million square feet of inventory in Dallas. A lot of it used to be build-to-suit, and so you knew it was essentially fully pre-leased. And now a lot of developers, when interest rates were low, they decided that it's a great market, it'll be absorbed, so we're going to build spec. But not all of it's being absorbed, and that's leading to some softness in the market and some increasing vacancy. But those factors just don't impact Class B. And there's the downside risk is more protected. We talked earlier about how new Class A development, we're also a Class B value add multifamily operator, but we have to be concerned about Class A development because it does have a domino effect on every category of multifamily. But you can really look at industrial in isolation, and you can really understand what the tenants are using or using the space for. The flex nature of the space allows us to adapt quickly. And so some spaces are not conducive to a retrofit. And so if you have a space that really only accommodates a single tenant, like, in retail, you have a restaurant tenant, you can't really lease that to anyone else. If your restaurant tenant blows out, you can't lease that to anyone else. You're going to have to find a new restaurant tenant. And so with flex space, the downside risk, we can manage it a little bit better because we can adjust the use of the space a little bit more than we could if it was a bulk distribution facility.
Mm-hmm. Yeah, on that point, I agree. I think that there needs to be a delineation between industrial from warehousing to non-warehousing, because that warehousing side, that's what's getting a lot of the headline news right now. You're seeing lots of new inventory, downward pressure on pricing, lots of vacancy coming on, and that's true in a lot of markets, but that's not representative of the whole. And I'm that kind of leads to the next question I have is, what are you forecasting for the Class B market over the short to medium term?
Certainly not the rent growth we've seen. I mean, we had considerable mark-to-markets, and I mentioned earlier, as I'm sure you're aware, 3% step-ups are typically common for industrial, especially with bulk distribution warehouses for annual escalations. But we were getting 4 to 5%, and we were getting significant mark-to-markets, buying deals with in-place rents well below market from mom and pop sellers who hadn't moved rents, or they had moved them 3% and hadn't touched the rents in years. And we were able to go in and move rents to market. And so we don't anticipate that to be the case. There's some mark-to-market opportunity. I mean, we were getting crazy mark-to-markets on some of our Class B. I mean, 40, 50% mark-to-markets. Now, the base was much lower, $4 to $5 rents. It wasn't like you're going from 10 to 15 necessarily, although we were in some cases. We're tempering that back a little bit because a lot of that value add has been captured. Now we're focused more on basis and what's a reasonable basis going forward. But it's like I said earlier, it's hard to buy. We're competing against a lot of funds that have the pressure to deploy capital. I'm not even talking about syndicated operators. I'm talking about groups that have discretionary funds, and they raise a lot of that money in 22 before the slowdown in the market, and they're reaching the end of their deployment window. And so they're willing to accept lower returns or get more aggressive under underwriting because they're not going to return the capital to their LPs and forego those fees. I think we're dialing back. It might mean that we're not as competitive on some deals. We're not able to bid as much, but we're comfortable with that because we know that this business is very cyclical. It's very interest rate sensitive, and we were in a period of very low interest rates, and most market cycles typically last 7 to 8 years. The last cycle lasted 15 years. And so we have no illusions that it might not take just a year to get back to where we were. It might take a couple years, not to mention all the other accommodative fiscal and monetary policy that's still working itself through the system. It's just a lot of capital still chasing deals and with sometimes lower return expectations.
Yeah, it is crazy that you'd think with that huge uptick in interest rates, fastest they increased in decades, that there would be some tempering in the market. But for all those reasons that you mentioned, there hasn't been a big compression on pricing. If anything, it's just been people are accepting lower returns.
Yeah, and if you can't raise money now, I mean, it's much harder to raise that capital now because you go to your LPs, whether you're raising for a fund with big institutions, with the sovereign wealth funds or the pension funds, you say, okay, I'm targeting mid-teens returns. And they say, well, fixed income is finally attractive and my discount rate is 8%. And I just have to be able to pay. I just need my assets to match my liabilities. I need to get 8% and treasuries yield 5.5%. It's hard to get those types of investors to commit. And then if you go down to the high net worth type investor, a lot of them have no deployment pressure at all. They like to invest in real estate, but they don't necessarily have to. They can sit in whatever risk class they want, and they can be risk on, they can be risk off. And a lot of them have just said, whether it's treasuries or real estate credit's just more appealing right now. That will probably shift, and if the Fed eventually cuts rates to stimulate growth or the economy, or if there's a slowdown or inflation finally gets under check, maybe that will change. But for the foreseeable future, debt's more attractive, whether it's senior first secured or subordinated debt.
Mm-hmm. Yeah, well said. Circling back to how you guys look at opportunities, we talked about how you guys look at markets. How do you look at individual buildings? What's of interest to you? What does a building need to have?
It has to have one or a couple of value-add components. And so sometimes that's buying well below replacement costs. We want the obvious characteristics: location, tenant profile. We want the buildings themselves to be attractive to tenants. And we're also thinking about how we'll exit those deals. But from an operational standpoint, we like some deals that might not necessarily be vacant, but have some lease-up potential. So we bought deals that have vacancy between 10 to 50%, and we'll buy from a seller who needs liquidity for because of a maturity default or an upcoming loan, or a loan coming due, or a seller whose equity wants out of the deal and they don't necessarily want to invest in the make ready to get spaces into leasable condition. So we'll buy those deals. That's our value add. We can get rents. We can get a stabilized NOI from that. Sometimes, I mentioned earlier, we buy deals where in-place rents are well below market, mismanaged, or operationally inefficient buildings and management. So we'll go in and improve that, cure some deferred maintenance, landscaping, roofs, sidewalks, you name it. And it's just some assets sometimes for Class B industrial, you got to go in and do a lot of work, but it requires a lot of capital to do it. But we'll get it at a reasonable enough basis to make it worthwhile. So those are the very high level, what you would expect from a value add operator. We're typically not. We'll look at some opportunistic deals too. We'll look at some fully vacant buildings, but those are just much more difficult. They're harder to finance. Lenders, especially in this environment, it's difficult to get debt at all. So buying a vacant building is not necessarily attractive to a wide range of lenders who are a lot of them are just on the sidelines. They're not even quoting us on deals. That is a big component of it. Now it's much different than it was a couple of years ago, not just because of rising interest rates, but a lot of lenders, the regional banks, the money center banks are largely on the sidelines. But some of our other lenders, the life cos, debt funds, a lot of them are more restrictive with their covenants around DSCR and debt yields. Some of them used to provide us future funding, so we didn't have to raise all the equity up front to fund our future TI and leasing costs. We don't get as much of that anymore. And a couple of years ago, we were able to get pretty consistently 5-year money, 3 years, 2 1-year extension options with full term IO. And we'll be lucky today to get 2 to 3 years of IO before the loan starts to amortize.
Yeah, that's a big difference. I wanted to drill in on one point that you made about you want to get buildings that tenants find attractive. What do you typically hear that tenants want in a building?
They care most about the functionality and how does the space cater to their business. They're not so much interested in the bells and whistles and extraneous art or anything like that. They want to understand how you can cater to their needs. So sometimes we'll show a space to a prospective tenant and the space isn't in the condition the tenant would need, but we do a good job of understanding exactly what the build out would look like and pricing it out and seeing if the math works with the rents. And sometimes if it requires a higher TI build out, then we'll amortize the tenant improvements into the rent. So that's really it. I mean, we spend a lot of time with tenants. Our property managers send out a tenant survey every year across our portfolio. It covers a wide range of industries because we have a diverse tenant mix, and so that informs us. And it's not necessarily a survey for the entire market, but it's representative of a lot of different industries. So we get a pretty good idea about what tenants like and what they don't like or what they need. And when renewals come due, a tenant might come to us and say, hey, I want to stay, but I need this enhancement to my space. And that might be part of the TI package as part of the renewal.
Yeah, I bet you get a ton of insight from that survey. Do you get a lot of participation in it?
Yeah, I'm not part of that, but I mean, I think it's upwards of 75% response rate.
Yeah, there'd be a ton of information to glean from that. I think that's a great idea, is to survey tenants regularly.
Yeah, and the good thing about our, just to add on to that, we focus heavily on relationships with tenants as well. When you have a lot of tenants under 10,000 feet, sometimes under 5,000 feet, it's a single owner. They care very much about these spaces. They're often sticky tenants, so they're there for a long time. And so we place a heavy emphasis on client service, tenant relationships, fixing issues quickly as they come up. It's much more management intensive than it would be for a Class A bulk distribution facility. But because of that, we feel like we're getting a premium for that in terms of our risk adjusted return, and we can get a lot of information from it. It's more management intensive because of a lot of tenants, but it's still not nearly as management intensive as multifamily, and that's also a differentiator I explained to investors I didn't mention earlier, but just kind of circling back to that.
Do you want to elaborate on that a little bit more? Because I agree, I think that is a huge component of it.
Yeah, management for multifamily is a full-time job. You're dealing with sometimes, if it's 300 units, sometimes you're dealing with 400 people, 400 plus people, depending on the mix of 1 bedroom, 2 bedroom, 3 bedroom apartments. And when issues come up in multifamily, you often have emotional type residents because it's where they live, and they're going to be in your ear. They're going to be writing Yelp reviews. The turnover is higher for property management staff than it is for property management staff in multifamily than it is for industrial. It's just there's a different type of emotion and feeling about it. When issues come up in a Class B space, it's usually an easier. It's not always a great conversation, but it's not usually an emotional conversation. A tenant can tell you their issue. Okay, our property manager can account for it. You can send a maintenance technician if you need to fix the issue. But you're also dealing with a lot more residents in a multifamily deal than you would tenants in an industrial deal. So more things can naturally go wrong. Insurers, I listened to your episode about insurance. There's much more that can go wrong on the insurance side in multifamily, just because of the way the buildings are structured. You could have property, you could have liability insurance, and residents can get very aggressive with litigation on the multifamily side.
And they also just have so much more protection from different layers of government in terms of the eviction process and dealing with disputes, whereas industrial, for the most part, just follows contract law. So it becomes much more difficult if you have an issue with a tenant in residential, multifamily, than it is in industrial.
Sure, and we're not in rent controlled markets for multifamily, but if you try to move rents in multifamily in the same way you do in industrial, you're also typically going to get more of an emotional response and a more difficult conversation. And you're going to have to deal with the turn costs and potentially disruptive residents. After the pandemic, we had a lot of issues in multifamily with collections because of the eviction moratorium. And so we had a lot of tenants who were just squatting at our assets because we couldn't evict them, even though they were non-paying tenants. And even though they still had income, they had PPP income, they had job income. But you're right, the protections are just stronger for residents in multifamily. Makes it harder operationally.
Yeah, I think that's those things that you mentioned are are some of the key reasons on why industrial, at least in my mind, looks a lot more attractive. So there's a pretty broad audience that will listen to this. It'll be a mix of investors, owners, brokers, affiliated professionals. What questions haven't I asked that you think would be important for them to know?
I would say that experience matters, and I touched on the fact that a lot of syndicators, more on the multifamily side, are going to get in trouble. Part of it is they haven't gone through a full cycle, and so it's one of those things that experience matters, and your ability to do what you say you're going to do is going to matter. We see a lot of off-market deals because we're a tenured sponsor, and a seller and their broker feel confident that if we say we're going to transact, we're going to be able to line up the debt and equity financing, even though we syndicate. And so a lot of brokers necessarily, they might look at the potential buyer pool on the other side, and they'll say, well, okay, this buyer is offering the best price, best terms for my seller, but how is that seller going to perform when it comes time to perform? And what we've seen on some deals is that we're often getting better pricing. We're not necessarily the highest bidder, but we'll get awarded the deal because some brokers and their sellers place a premium on an execution of financing, and they're worried about the other sellers not being able to commit, or they commit, but they're not necessarily able to follow through. And so I would say just the reputation part of it is the most important.
Yeah, and I couldn't agree more with that. It's so much so that I actually say, and I've said numerous times on this channel, is that most people shouldn't invest in industrial real estate because it does take so much time and energy and commitment to not just understanding what industrial real estate is and potential pitfalls, but also understanding a market at such a deep level that you're not deploying dumb money. It's an effort. So I think the average investor is best to steer away from it in the capacity of doing it themselves. Going through as an LP with a sophisticated operator like yourself, I think that that's a fantastic opportunity and something that people should explore. But I couldn't agree more with the importance of having experience, especially if we're going into a bit of a down cycle.
Yeah, and the other thing I would add is really from my perspective, obviously my main function is to raise capital, but I want to raise capital from educated investors and investors who really understand what they're investing in. Because the worst thing you can have are a bunch of small investors who don't know what a cap rate is, or they don't really understand what they're investing in. And when things go wrong, which they inevitably do in real estate, you're going to get frantic calls from them. And so I would much rather have investors really do the legwork up front and ask the questions and ask questions about, any question is a good question, but things like, what are the downside risks? How are you underwriting this deal? What's your fee structure? What's your promote structure, your co-invest? I would much rather have that. And I think that's what investors should do. And it's probably what they're going to do more so going forward, given that I think there's going to be a lot of unfortunate outcomes that just haven't been worked through for some of these syndicators.
I'm hearing it more and more, not on the industrial side. I haven't heard of distress outside of perhaps somebody that may be over leveraged on a large warehouse, but most of that's even institutionally owned, and they can weather this a lot better. And if they've got rent coming in anyways, it's not as big of a deal. On the multifamily side, I'm already starting to hear a lot of distress and early signs that people are underwater on their mortgages. Their rents have been flat. They've had increase in expenses. It'll be interesting to see what the rest of 2024 has in store, but I'd be worried if I was an investor in a poorly funded multifamily syndicate right now.
Yeah, on industrial, even at the peak of the market, we were maxing out our LTVs at 65% with mostly fixed rate debt. Sometimes 60%. Now you're not going to be able to get above 55%. We don't use any mezz or preferred equity. And I think on the industrial side, there are some sponsors that may layer on a 5 to 10% piece of mezz or pref as part of their total stack. But on the multifamily side, I've seen as high as 25% of the total stack being preferred equity. And so your last dollar of loan exposure is 85, 90%. It's just not the case in multifamily. So like you said, you're not going to have as much distress. You have good operational fundamentals for industrial that you don't necessarily have for multifamily. And we talked at the outset about the lease structures. That's the big one. And I think that's the one that really hits home with investors. The fact that property taxes, insurance, and common area maintenance are pass-through expenses is a huge thing. That said, as an owner, you want to be responsible and you want to do right by your tenants. You don't want to just say, well, I can pass through these expenses, so I don't care where insurance premiums come in or where property taxes come in. We're aggressive in getting the best coverage we can at the best potential premium, and then protesting property taxes because you want to manage that appropriately as well. You don't want to get the idea that you don't really care where those line items go, because then it affects the ability for tenants to be able to afford those rents. And so you want to do right by your tenants, but you can certainly have some more protection as an investor there than you can in multifamily, where we're underwriting in a lot of cases. We're not as active buying or underwriting new deals for multifamily, but the most rent growth I've seen for year one is 2%, but insurance is rising 30%, property taxes at least 15, 20%, repairs and maintenance is doubled. So eventually you worry it's going to eat into your NOI growth, whereas you just don't have that for industrial unless you have tenants blowing out of your spaces.
Mm-hmm. Yeah, that's very well said. Yeah, and I agree. I think all those things you said are why I'm such a big fan of industrial, and I can tell that you are as well. What's if someone wants to reach out, either talk about deals or talk about properties, what's the best way for people to get in touch with you?
Sure. My email, Phil, phil.copulsky@gmail.com. I'm happy to connect through there. It's probably the best way. I check it all the time. So, and then I'm happy to talk to anyone who wants to dive more or learn more about Westmount or just talk industrial.
Awesome. Well, I'm sure you'll have some people reaching out because I love talking about industrial, and I can tell you do as well. So I'm sure people will reach out, and I encourage them to do so. And thank you for this. I really do appreciate you taking the time to do this. And it'd be interesting if you're up for it, perhaps even 6 months or a year from now, we do a follow-up one and just see how things are shaking in your world and see if anything new's changed in the industrial space. Yeah,
let's do it. I enjoyed this. It's and it's of great value to my investors as well. It's a way that if they're in their car or at home or on a walk, they can listen to this and kind of hear our views of the market and get some value. So definitely, let's put it on the calendar for 6 months from now, and let's see if transaction volumes have picked up or maybe interest rates have come down and where the state of the market looks at that point.
Sounds like a plan. I'll diarize that. We'll probably even put something in the calendar later, but we'll aim to put something in for like early fall, mid-fall.
Sounds good. Maybe we see what happens with the election, and maybe some buyers and sellers start transacting because of that uncertainty is passed. Once we know who's going to be the next U.S. president,
that'll be an interesting one. Yeah. So let's aim for like mid-November. That'd be a good time to do it.
Yeah. Sounds good.
Okay. Awesome. Well, thanks again, Phil. Really do appreciate your time and your insights into the market.
Thanks for having me, Chad. I appreciate it.